Ladies and gentlemen, good day and welcome to the SGmart Limited Q1FY26 earnings conference call hosted by Ambit Capital Private Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference has been recorded. I now hand the conference over to Mr. Kumar Saumya. Thank you, and over to you, sir.
Thank you, Anushka. Good afternoon, everyone, and thank you for joining us today. We at Ambit Capital are pleased to host SGmart's Q1FY26 result conference call. We have with us today Mr. Amit Thakur, Director B2B Metal Trading, Mr. Suraj Kumar, Chief Financial Officer, Mr. Naman Rastogi, GM Strategy, Mr. Archit Arora, VP Service Center and Distribution Business, Mrs. Anamika Gulati, GM Renewable Business, and Mr. Anubhav Gupta, Group Chief Strategy Officer. I would now hand over the call to the management for an opening remark, post which we will open the floor for a Q&A. Over to you, sir. Thank you.
Thanks, Kumar, and thanks to Ambit for hosting SGmart for its Q1 FY26 earnings call. I welcome all the participants who have joined onto this call. We are a young team, that's why you see all the business heads are here to attend this call and address any queries which you may have. And we also have Mr. Shailendra Arora, who heads our TMT business. It's been 2 years since we conceptualized SGmart and started the business with the vision to become India's leading B2B trading platform. Over the last 8 quarters, we have been able to create 4 business verticals to achieve this goal. Number 1 business vertical is B2B metal trading. Second is establishment of a network of service centers in the country and abroad. Third is the distribution business, which comprises of TMT and other downstream steel products. And number 4 vertical, which we added recently, is the renewable business. Over this time, we have been able to create a network wherein we have 2,313 customers which are on board and almost 246 suppliers are onboarded with us. So that's the strength of our marketplace, what we have created in the last 2 years. The competence here is to buy bulk steel from the steel mills and either to trade it to gain sales volume or to do some value add to gain on the profitability. Interestingly, if I elaborate on this, in FY25, the service center business contributed 33% to our volume, but in terms of EBITDA, the contribution was 50%. Similarly, in Q1, the service center business contributed 50% to the revenue, and the contribution to EBITDA was 60%. And we added renewable business just to continue on this strategy, wherein you keep on adding multiple product lines which are highly profitable, and it shall improve the profitability for the company and ultimately improve the ROE profile. TMT business is now on a pure royalty model, which is right now breaking even. It may require some minor investments to acquire more customers and get more partners on board. Now, coming specifically to Q1 performance, there was a miss on B2B trading volume due to poor steel availability in India in the first 3 months of the current financial year. This is evident from the sales volume data of top 3 steel producers which has come out. The Q1 volume for them declined by 11% versus Q4 FY25. So this also impacted SGmart because right now almost 95% of business is coming from steel. So steel availability did impact our business as well. But coming to service center business, the monthly run rate is now 40,000 ton a month from 5 operational service centers, which are one in Ghaziabad, second in Raipur, third in Bangalore, fourth in Pune, and the fifth one in Dubai. We have acquired land for 2 new service centers which are under construction, one in Jaipur and second one in Ahmedabad. And we are scouting for 3 more land parcels, one in Indore, second in Punjab, and thirdly in South India. It could be either Chennai or Hyderabad. Meanwhile, we are creating our positioning pan India, and we are excited the way this business model got scaled up, which is backed by our brand equity. So what we have done is that we have taken 2 service centers on lease as well in the second quarter, one in Indore and second one in Ahmedabad. So the volumes from these leased out service centers will start flowing from Q2 onwards. This goes on to adding to the asset light model, where we believe that one city may have more potential to do more volume. So rather than investing into second service center, better is to take on the lease ones. Third vertical, TMT, it is scaling up pretty well. The Q4 volume was 39,000 tons versus 33,000 tons in Q4. We added one partner in Chennai in Q1, and in next 9 months we are going to add 3 more, maybe 4. One in West Bengal, second in Andhra Pradesh, third in Gujarat, and fourth one to cater to the East market. Right now there are 11 partners, franchisee partners, which are operational. Lastly, on the solar business, we started on a strong note with the current order book of around 285 crore rupees. Now this is executable over the next 6 months, and we expect similar worth of orders to book in next 1 to 2 months. So for the full year, we shall be doing around 400 to 500 crore worth of business from renewable business. On the distribution business, which is non-TMT, which are steel downstream products. Here also the revenue for the Q1 was 196 crores, which was a significant scale up versus Q4, where the revenue was around 125-30 crore rupees. So that business is also doing pretty well as we continue to scale that up. Now, so in Q1, when we saw that the steel supply is going to become a challenge, so we focused on the profitability. So whatever steel we bought, we ensured that we do some value add, we do some processing, and we generate profits out of it. That's why, despite such a low volume and such a low revenue, our EBITDA margin increased, which surpassed 3%. So this also suggests that on how a lean cost model we are working, despite decline in revenue. I'm talking about QOQ. We are able to improve our EBITDA margins. Now coming like how we see the next 9 months. We are not at all disappointed by our Q1 performance because what we see is that almost 7 million ton of new steel capacity is going to get added in the second half, with the Jindal Steel and Power blast furnace and the Jindal Stainless blast furnace getting fired up, and this will almost add 10% to the existing steel capacity in the country. And what we also saw was that the imports also opened up for next 3-4 months. So there is no risk to our FY26 guidance of 200 crore worth of EBITDA. We are 100% maintaining this guidance. You shall see the ramp up from Q2 onward itself, and quarter on quarter you will see improvement in the revenue and absolute EBITDA. Now coming on the balance sheet front, our working capital days came down to 15 days, which was always the sustainable case, right? In Q4 it was slightly bloated because of the advance to steel suppliers ahead of the tariff which were imposed by the government. But now things are back back on track, and our working capital days is 15, which shall remain at similar levels. This helped us to generate ROC of 21% on annualized basis. Now this ROC will improve further as our profits improve from Q1 from Q2 onwards. So full year ROC shall be upward of 25%. We now have almost 1,000 crore worth of cash on our balance sheet, for which we believe that the mainly deployment will be for opening of warehouses and service centers. Now this will only be like 150-200 crore worth of annual capex. We don't anticipate more than that. And the good part is that we are generating similar cash flows also on annual basis. So mainly the cash will be used to fund the working capital. As we scale up our business quickly, it's just that one roadblock we saw in Q1 because of short supply of steel. But as things improve, we are highly geared up to double our turnover in next 2 years, so that whatever verticals, whatever ecosystem we created, we are able to leverage that on full basis. That's all from our side, Soumya. We can now have a floor open for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Vaibhav Mishra from Feen Allies. Please proceed.
Hello, sir. Good afternoon. Sir, my question is regarding the...
Sorry to interrupt, Mr. Vaibhav. Could you please unmute yourself and then speak?
Ma'am, I have already unmuted myself. Hello, I'm audible now? Hello? Sir, I'm audible now? Hello? Am I audible?
Vaibhav, sir, we are...
Am I audible now?
Hear you. We'll proceed with the next question. Please come back in the queue. We take the next question from the line of Vivek Patel, an individual investor. Please proceed.
Good afternoon, everyone. I'm hoping I'm audible. So firstly, just had a quick question in terms of, is there any specific reason why our B2B metal trading segment suffered a much sharper decline than the industry when 11% downfall that was seen in the primary steel producers? Anything like internally that has happened which has led to this sharper decline? Thank you.
We take the next question from the line of CA Garvit Goyal from Invest Analytics LLP. Please proceed.
Hi, am I audible? Hello, am I audible? Hello. I think there is some issue in this con call because previous participants were audible and you said they are not audible. Hello.
Anushka, is it that there is some problem at your end that participants are not able to hear their voices?
Hello. I think there is some problem at the moderator end.
Anushka?
Yes, sir.
Hello. Am I audible?
Yeah, please go ahead.
Thank you. Thank you for the opportunity. Sir, in the last few quarters, we have been seeing the divergence in actual results from the commentary, where we have missed our guidance multiple times. And in addition to that, promoter holdings is also getting reduced consistently over the quarters. So last time when we spoke, it was already middle of the quarter and you guided for 50 crore EBITDA for Q1 and that growth to be in the line with the EBITDA growth only. But we did not achieve that. So my question is like I want to understand from you why are we giving so much aggressive targets every time to the investors and falling away behind of them if the environment is so much out of our control, particularly into the B2B metal trading side? Because last time also you mentioned like you have arranged or secured the availability of the steel, but this time we are saying that steel availability is not there, was not there in the particular quarter. And secondly, if the opportunity is so big as per the management, then why the promoter holding is getting reduced, sir? So these are my two questions, sir. Thank you.
Thanks, Mr. Goyal. So coming to the first part of it, so number one is that full year target of 200 crore EBITDA in FY26. Right now we are into fourth month of current financial year. So what I can tell you is that there is not going to be any miss on this, right? Of course, steel is a volatile business. Trading is even more volatile, right? So quarter on quarter there could be some misses and hits. Okay. Now, why we are confident of 200 crore EBITDA or to achieve another 165 crore of EBITDA in the next 3 quarters, which is a run rate of around 55 crore on quarterly basis. The groundwork, the ecosystem which we have built, right, in last 2 years, whether it is related to the service centers which are now operational or the new service centers which we are going to open, right, or the leased ones which we started, the renewable business which we started and the order book what we have in hands, right, or the TMT business scalability, right, the distribution products for downstream steel products, that scalability, right. So it's just that B2B metal trading, which is a highly voluminous and it appears high on revenue in terms of value, but rest other businesses are doing pretty well, right, and the contribution in earnings from B2B metal trading is definitely lower than what it looks on the revenue side. So that's why we are confident that 200 crore EBITDA number shall be achieved, and we understand that we have been aggressive, right, in terms of creating the business model, and similarly we want to articulate the same strategy to our investors and analysts, right, that this is what we are capable of. It's just that Q1 things were not in our control, but things are improving, and it is highly visible that how we are going to achieve our numbers for rest of the 3 quarters. Coming on to the second question, promoter holding right now is 51%, okay, and it is not going to get changed. I know maybe on website there could be some SEBI-related classification, we shall rectify it. So what I can tell you is the family owns 51%, and it is not going to go below this number at any cost.
Understood. And so lastly, on the PAT growth, last time you mentioned PAT growth will be in line with the EBITDA growth only, but our finance cost is increasing significantly, which is hampering our PAT growth. So when we say 200 CR for EBITDA for full year, what kind of PAT growth are we anticipating?
So see, I mean, the interest cost shall be also offset by the other income which comes, right? So that's why we believe that PAT growth will match the EBITDA growth.
So last year we did around 100 CR PAT, right? So we will be doing 200 CR PAT this year.
Yes, I mean, you can do the maths, right? Again, I'm saying that the EBITDA growth will flow down the PAT growth.
Okay, sir. Understood, sir. All the best for the future. Thank you very much.
Thanks.
Thank you. The next question is from the line of Aman. Sorry to interrupt, that participant went out from the queue. The next question is from the line of Dev Jatia from Seven Rivers Holding. Please proceed. I would request Mr. Dev to unmute themselves and then speak. As there was no response from the participant, we would like to move to the next participant. The next question is from the line of Aryaman Agarwal from Money Stories Asset Management. Please proceed.
Am I audible? So you had given a guidance of
slightly echo. If you can speak slightly.
Is it better now?
Oh, awesome. Go ahead, please.
Perfect. So you had given a long-term guidance of 18,000 crores in 2027. So one, are we still intact with that guidance, and also what sort of a guidance are we looking at for this year?
So Aryaman, see, I mean, in terms of value, right, it also depends on how the steel prices are behaving, right, which no one knows, right? Steel was like 48,000 rupees per ton 6 months back. It went up to 53,000 rupees a ton, and now again it may go back, it may go up, right? So 5 to 10% price variation is a very normal thing in steel business, right? So that's why we are now giving guidance on the absolute EBITDA front, right? Because we know that our EBITDA spreads are protected in terms of volumes we do, right? It doesn't depend on how the NSR is moving. NSR is net selling realization. So that's why we are saying that FY26 we shall do 200 crore EBITDA, which shall go up to 400 crore EBITDA in FY27. Now for that, the revenue could be either 16,000 crores or 20,000 crores. Tough to say. It depends on like how the steel prices behave.
Got it. And in the service center bit, how do you see the service centers ramping up over the next 2-3 years, sir?
Yes. So we are pretty happy with the performance of this business vertical in particular. Okay. I mean, we are already doing 40,000 ton on monthly basis, right? Which was despite the fact that steel availability was low, right? If steel was there, we could have touched 50,000-60,000 tons also on monthly run rate basis, right? From the 5 service centers which are currently operational. We want to keep on adding 5 new service centers on our own, which will be owned by SGmart, right? Every year, and 2, 3, 4 service centers we may add on lease basis as well, right? So which will further improve our ROC, and it will help us faster scalability, because if we have to go and put up a center, although it's a small one, but still it requires some timelines, right? So that's why we are more excited to take this model on lease basis as well. So yes, and in terms of margins, we are easily making 3.5%-4% EBITDA margin, right? Which is also like how we expected.
Got it. Got it. Thank you.
Thank you. The next question is from the line of Rajiv Thakur from Algonex Capital. Please proceed.
Yeah, my question, sir, is related to two things. One is related to the employee cost that has increased. So, is there increase in the employee count in the recent past? And since you intend to increase and scale up the various businesses outside metal trading, it would certainly require a lot of increase in the sales team. So, what's the plan in terms of having the increase in the headcount over the upcoming quarters? That's the first question.
Right. So there are two reasons to this. One is like small portion of like notional ESOP expense which gets accounted in P&L, but that's a bit small. Second, in Q1, we hired a team for renewable business, right? The benefits will start flowing in terms of revenue EBITDA and from Q2 onwards, as you would see. And of course, TMT business also got scaled up, so some addition to sales team there. So this employee cost increase is in line with the scalability of these business verticals over the next 2 to 3 quarters.
So my next question is more related to the safeguard duty that was applied, of 12%. And, in the various commentary and news information that we observed, that is also not something which is sufficing the overall, barrier that the Indian industry was kind of expecting. So is that kind of going to be having any impact on the overall steel availability point which you are referring to?
So see, I mean, such incidents or such situations are always short-term basis, right? I mean, yes, there was a safeguard duty which came in, and imports stopped in the country. Then the steel mills went for maintenance shutdowns, right? That's why in Q1 the sales volume of the top 3 steel producers was down 11%. I'm talking about Q1 versus Q4, right? So, but this situation will not prolong, right? I mean, at some point, China prices came down so sharply that even imports became viable, and we saw that traders booking imports in month of June and July, right? And then from the third quarter, like I said, the Jindal Steel Power Mill and Jindal Stainless Mill, right? Those blast furnaces will be operational, and we may see almost 10% increase in the flat steel supply, right? So yes, I mean, whatever happens, it's always like short-term driven. Long-term, is India going to produce more steel? Answer is yes. Are Indian steel mills encouraged enough to put up more capacities? Answer is yes. Should India be having more steel supply? Answer is yes.
So my last question is more about, Jindal Steel themselves have kind of created a end customer kind of app where they can, go ahead and access and, take the steel directly. So is that kind of a direct competition for us? And since we are also kind of partner to JSW, is there some kind of conflict out there?
No, we don't see any conflict there. Their business model is slightly different than what we do, right? I mean, India having produced 150 million tons of steel every year, and which is going to go up by 7-8% year on year through FY30. So, I mean, opportunity size is quite huge, right? So each one of the player has his own segment to operate into, right? Their model is pretty different than what we do.
All right. Thank you and wish you all the best. Thank you.
Thank you. The next question is from the line of Akshit Gupta from Oakland Capital. Please proceed.
Hello.
Hi, Akshit, go ahead, please.
Thanks for giving me the opportunity. My question was on logistics cost. So earlier you have guided that you will be setting up 101 service center, but now you have revised down to 30. So because of this higher concentration at one place, won't there be a risk of average transportation distance which would have increased to the customers? So like the procurement discount that we get from steel suppliers, won't that offset by transportation cost?
Akshay, when we said that we want to open 100 service centers in the country, okay, our assumption was that one service center will not give more than 5,000 tons of volume, okay, on monthly basis. But having operated 4 service centers in India so far, and having leased out 2 service centers, right, adding to those 4 operational, what we see is that one service center has a capability to do monthly volume of 10 to 15,000 tons. Okay, so I mean, that's why the number of service centers came down by like 2/3. Okay, because earlier assumption was that service centers will be doing business from 4 to 5,000 tons, but what we are seeing is that one service center can do actually 10 to 15,000 tons. So you cannot build 100 service centers which are capable of doing 10 to 15,000 tons of monthly volume, right? This much of demand is not there. Idea is that we open 20-30 service centers which can do 10-15,000 monthly volume, right? And then we see that if we have to go to smaller towns, and it should not cannibalize our service centers which are operational, right? So that part will start in after 2 years, I would say. If one service center were doing 4,000-5,000 tons, then we would have been forced to open more service centers. But one service center is giving me more than what I expected, right? Then like going into tier 2, tier 3 towns, that will be stage 2. So
but
although
the impact of logistics cost,
it is there, but it is manageable. Customer is ready to pay that.
Okay.
Right. So just to conclude this, that we may have reduced the guidance to open number of service centers, but the revenue, the volume from service centers will be similar, right? So we have not cut the guidance on revenue or volume from the service center business.
Okay. And you have now leased 2 new service centers. So in Q4, you have guided that each service center does an around of 20 crores of EBITDA. So considering that it will the new 2 service center which we have leased will be functional from Q2. So will that also add an extra of 30 crores of EBITDA for the year?
See, I mean, these service centers, obviously you need to pay a nominal rent, right, to the owner. Okay. So if on our own service center we make 4% EBITDA margin, here the margin will be say 3%, right? Because we are not investing anything. And yes, so here the simple maths is that assuming one service center does 10,000 ton on monthly basis, so full year is 120,000 ton. On that you make 15% 1,500 to 2,000 rupees per ton EBITDA, right? So which does give that number what you're talking about. So yes, I mean idea to open more and more service centers either through own model or lease model. The idea is to increase EBITDA, which could be like 15 to 20 crore addition per service center.
Okay. And in Q4, we have paid advances to the suppliers for the procurement of steel. And at that time, steel prices were down. After that, safeguard duty got activated in the country. So, is there any reason that we have bought we have paid advances to the steel at a cheaper price? That's why our EBITDA margin has improved in this quarter.
Not really, because in June month, steel prices also came down, right? So there is no inventory loss or gain in this 35 crore of Q1 EBITDA.
Okay. And also, now Shiv Bansal has resigned from his position. So, any reason that he resigned? And also, he used to work in B2B trading segment, and this quarter, B2B trading segment volumes degrow by 50%. So, is there any relation or it is some other reason?
No, it's not like that. Actually, the B2B business is being handled by Amit Thakur, who is a director on board as well, right? So B2B business has no relation to Mr. Shiv Bansal. Shiv Bansal resigned because what we wanted was to have a head office of SGmart in New Delhi. Right, Shiv Bansal ji were operating from Pune office. So because of family reasons, he could not shift to or move to Delhi, right? And anyways, in 1 to 2 years, he was at his retirement age. So he decided to kind of retire and move on. And now, we have business verticals, all 4 or 5, right? Who are sitting with me as we speak now, and yes, there is no disruption what we see from this management team.
Okay. Okay, thanks for answering the questions. I will get back in queue.
Thanks.
Thank you. The next question is from the line of Vikas Mistry from Moonshot Ventures. Please proceed.
Hi, Anubhav. Thanks for the opportunity. So my question is on technology side. So we are already seeing multiple startups doing B2B digitalization change. So in that context, do we see some bit of competition from that side? And what are our customer parameters like turnaround time and satisfactions on that part?
See, like I said, that if one has to compete specifically in steel trading, which is 150 million ton of annual market, because every player, whether it's a startup or it's an established player, okay, like now SGmart, we have been into operations for last 2 years. So everyone has created its own business model, right? What verticals we have created, what I can tell you is that no one is emulating that. Okay, no one is investing resources in creating the service centers. No one has a relationship with steel players, what SGmart has, okay, which is backed by the group sister company in terms of steel procurement. Okay, no one has ventured into renewable business like how we did, right? Very few of them have their own private labels in TNT for steel or other downstream products, right? So similarly, other player may have other strengths, right? What SGmart is doing, we are playing on our strengths, right? and based on that, we have created these 4 business verticals. But what I can tell you is that no one is comparable to SGmart if you look at these 4 verticals.
Yeah, that is pretty understandable, but my question is specifically to B2B trading because these people are trying to give bundling of other services like software for them, transparency in terms of pricing and some other parameters also. So is there any threat to this B2B trading which we thought that will scale up to maybe 6,000-7,000 crore in a couple of years? Can we able to do that, or is there any threat to that part of business?
Again, see, if one has to compete in B2B metal space, right, that the player must be carrying the relationship with steel mills similar to what SGmart is having today, which we believe that none of the players has that capability as on date.
Okay, but one of the players is also doing $1 billion of revenue from that, so.
$1 billion is what? Like when steel sector is like what? $50 billion on annualized basis. More.
Okay.
70,
it's more than that. Yeah. Yeah, extension of that question is that, so in last quarter we have some shortages, so do we have to say no to some of our customers, and what are their reactions after that, and how we try to reduce that? Although it looks like that the lot of the supply of steel mills will be coming, but in that case, so in last quarter if we have said no to some customers, so how they have procured their requirements?
No, so definitely it's a situation where our sales team never wants to come, but yes. So see, there are 2 parts, right? One is then you do the allocation customer-wise, right? It's not that you give 0 tons to any customer, right? You allocate whatever you have because we have, like I said, 2,500 customers, right? So you have aggregation, demand aggregation from them. And whatever steel comes, say in Q1 it was lower, so then you do allocation on pro rata basis. Second is that customers also understand that it's not because of SGmart, it's because of the steel industry where the production has been lower, right? And thirdly, Vikas, to be honest, Q1 in terms of business has also been slow, right? Because of the pre-monsoon which came in like in June heavily, right? The construction activities halted big time. Auto demand, white good demand, everything is like kind of a bit sluggish right now, right? So it's not that our sales team had to face major flack because of steel shortage.
Thanks, Anubhav. Continue to grow. Thank you. Thanks a lot.
Thanks, Vikas.
Thank you. The next question is from the line of Dharmil Shah from Dalmus Capital Management. Please proceed.
Hi. Thank you for taking my question. Just one question. For the B2B business, you mentioned that steel mills were able to supply 10% less than the previous quarter, but our volumes were down 55%. Just wanted to understand, what is the missing part here? It should be some other reason apart from the lower supply. And it's a stark difference from 10% and 55% volume degrowth.
There are 2 parts to it. Number one is overall steel supply shortage. Like I said, Indian steel mills produced 11% lower steel what they produced in Q4 FY25, right? So this is the macro thing. Second is when there is short supply, right? When there is limited steel, we want to use that steel to do value addition, do some processing, and sell it with higher profits, right? So we diverted all the steel to our service centers, and we generated more profits on that. That's why our Q1 EBITDA margin is 3%, right? Which is highest so far. Now, once the steel availability is there, right, we will start diverting steel for B2B metal trading also. So it's a situational thing, right, which we believe that will recover from Q3 onwards with the commencement of two blast furnaces, one from JSPL, second from Jindal Stainless.
Got it. And that's it. Thank you so much.
Thanks.
Thank you. The next question is from the line of Mehul Panchwani from 40 Cents. Please proceed.
Hello, sir. Thank you for the opportunity. Sir, I am new to this company, so can you please write on what do you mean by renewable business?
Sure. In renewable business, the first product what we are working on is solar structures, which are ground-mounted solar structures which are being used in the solar parks, right? So there are like 3-4 types of steel sections which are used to install the solar panels.
Okay. And sir, whom are you going to source it from?
Right. So here the raw material is coated steel, which we are buying from steel mills again, and there is a mild processing to that coated steel, which gets converted into an open section, which actually goes on site for the installation.
Okay. And sir, how much? Sorry.
So strength.
Yeah, go ahead.
Strength. Yeah. So there are two strengths which we played on. Number one is our steel buying, right? So we are buying HR coil. We can also buy coated steel, right, from the same steel mill, right? So our sourcing power, procurement power at the lower pricing, that is one. Second, that mild processing, what we are talking about, right, to make those open sections, we are installing those small machines at our service centers only, right? So we already have a network of 4 service centers in the country, right? We are using those service centers to feed the demand, right? Normally the solar parks are coming in Gujarat, Rajasthan, which we are feeding from our Ghaziabad service center. Then more mills will get installed in say our upcoming Hyderabad or Chennai service center, or say Bangalore, which can cater to South India demand, because a lot of solar parks are coming in Andhra Pradesh and Tamil Nadu and Telangana, of course. And some machines we may install in our Raipur service center, because some solar parks are also coming in Madhya Pradesh and Chhattisgarh belt as well, right? So these were the two strengths on which we played, and we saw that there is a gap, because this market is huge, right? And it was not being catered by a pan-India national player. So we jumped onto the opportunity and we opened the vertical.
Right, sir. So how much are they expecting it will add roughly to the top line for FY26?
We have 285 crore of order book, which shall be executed in next 3 months, right? And similar 280 crore, we shall be getting more. So put together should be around 550 to 600 crores worth of revenue should come from this vertical.
Right, sir. And regarding your service center, do you, since you mentioned about Gujarat, do we have any service centers in Gujarat?
Ahmedabad, we are scouting land. We have purchased land, right? The service center should be operational in 7-8 months.
Okay, that's the only one we are planning.
Plus, meanwhile, we took one service center on lease already, right? Ahmedabad market is so big. We believe that our service center, which will be owned by us, plus the lease one, we can operate both together to meet the demand.
Right, sir. Thank you so much and all the best.
Thank you.
Thank you. Before we proceed with the next question, ladies and gentlemen, please limit your questions as there are several participants waiting for their turn. The next question is from the line of Sneha Talreja from Nuvama. Please proceed.
Hi, good afternoon, team, and thank you for the opportunity. Questions from my end. One is related to seasonality. You, of course, mentioned that availability of steel will improve in H2, where those two plants come into play. But how can we see a quarter-on-quarter journey in terms of EBITDA movement? Of course, 35 odd crores clocked. You still have target of 165 odd crores. Can we see H2 be far more stronger in Q2 be, gradually slower? So some sense there would be helpful.
So Sneha, this is always the case, right? Even if you look at FY25, we did almost 70 crore of EBITDA, right, in second half versus 103 crore for the full year. Okay, so second half will always be skewed. Plus, our service centers, these leased ones, will be generating revenue. Plus, our renewable business will be generating revenue. So yes, you can say that the ramp up will be Q2, Q3, Q4. Every quarter we would be outperforming versus the previous quarter.
Understood. And the solar order, if I'm not wrong, you said it has to be executed within the next 3 months. Is that understanding correct?
That's right.
Understood. I think that's about it. Thanks, team. All the best.
Thank you. The next question is from the line of Chirag Shah from White Pine Investment Management. Please proceed.
Yeah, thanks for this opportunity. So I have a question on the scale of our operations. If you go back to the earlier interactions, given the market share where we are and given the lineage that we have, sequentially, despite steel availability being an issue, our volume should have been down so much. Ideally, we are in a phase where we should be growing our volumes quarter after quarter unless there is extreme seasonality. And if I look at the presentation, our volume is down 50% sequentially.
So this is only because of the B2B business, Chirag, right? Seasonality does come into play, but the bigger reason was a short supply of steel, okay, which is not in our control. As SGmart grows, we will add more products which are non-steel, right? So this impact will go down, correct, eventually. But see, we are a company, we are a group which is always profit and ROC focused. Despite the volume going down by 50%, as you mentioned, my EBITDA was almost flat, right? My ROC improved over last quarter.
No, my
right?
point is a bit different.
Yeah.
My point is a bit different. Even when you look at network service center, even over there the volume is lower. I'm trying to drive a point that this is based on our earlier interactions that you had on the call, that the scale of operation that we are, the unorganized nature of market and small players, there is an open field for us to grow. Okay, so I understand growth could be slower or smaller in that sense, but this is a complete reversal of the thesis that you had been highlighting some time back. Okay, so either your learning, your understanding has changed about the nature of business, the competitive intensity at ground level, how efficient is the unorganized market or regional players. And this disappointment is happening it's not the first quarter of disappointment. We have been disappointing for some of the other operational reasons. And I appreciate it's a business, there are challenges. I'm not even discounting it with this, but I'm trying to understand is your understanding of the opportunity in the near term that we have versus the longer term opportunity. I'm not even debating, but the scale versus the available opportunity for next 2-3 years, there is a disconnect. So Is there a rethinking on that side, or based on your experience now of last 12, 15 months?
So Chirag, let me be very, very clear. There is no reversal of thesis. Okay, there is no change of the business model. What we thought while starting SGmart 2 years ago, the disappointment in volumes, right? And obviously, eventually it flows down to the profits as well, is only because of the short steel supply in quarter 1, right? Now, the customers which we have, say 2,500 on board, it's a challenging business, but it's not that we are not able to sell to those 2,500 customers, or we are not competent enough to sell to those 2,500 customers who are who are already on board with us. If there is no steel, right, which is there for trading, right, my trading volume will come down. It's as simple as that, unless we start adding newer products. So we are evaluating more product categories outside steel, but not very aggressively. Steel is something which we understand. Okay, so we want to ensure that this 200 crore of EBITDA, 400 crore of EBITDA next year, we are able to generate this much of cash flow, this much of profits from the existing business. Then we invest into learning for other product categories, right? Because to understand the one product segment is not easy, right? These are cyclical. Trading of commodities is always cyclical, right? So learnings are very, very costly. If we have 1,000 crore cash lying in the books, that doesn't mean we take unnecessary risks on non-steel products, right? And like I mentioned earlier also, we are a management which is highly focused on absolute profits and absolute return profile. Okay, we are doing our homework. We are establishing the customer base. We are opening new service centers. We are talking to more and more steel mills, not only in India, but outside India also, to source steel, right, to ensure that the steel supply is smooth without any disruptions like what we saw in Q1. It may take 1-2 more quarters to see that steel itself will be so much available in India in next 6 months that we may not have such quarters where we may come and tell you, hey, I mean, we didn't get enough steel to grow our business. So I guess I mean, you have been patient, right, with us. We request you to just keep on monitoring us, keep on evaluating us, our performance on quarter basis. This enigma of disappointment will go away. I can promise you that.
No, I appreciate your honest answer. The only thing is, my thought process was that once you scale up the business, cyclicality becomes the inherent part of the business. You are linked to industry. When you are in a form of scaling up, given the opportunity, irrespective of the market conditions, there cannot be a decline in volumes, either be it service center or this. I understand growth could be lower. Fair point. Absolutely accept point. Fair point.
Chirag,
I will wait. We'll take it right now. We'll wait for 2 more quarters. Yeah.
Chirag. See, now just to gain volume, right? I could have sourced steel at expensive price. I could have sourced steel from imports even at much higher value, and then I would have sold in the market, done losses, right? And a lot of startups are doing that, right? A lot of companies in similar trade, you will see, okay, you can look at their EBITDA margins, which will be negative. Like I said, we don't want to do any business at a loss, right? I mean, we just don't understand that how to sell a product at 99 rupees when you buy that product at 100 rupees. We do not know that business, and we do not wish to know that business ever. Anything we buy at 100 rupees, it has to be sold above 100 rupees. Right?
So you are in a sense saying that you need a normalized business condition to really take advantage of the arbitrage opportunities or inefficiencies which are there.
We are not working on any arbitrage. We are working on a very solid business plan, Chirag.
Okay.
Right? We are not working on arbitrage. We are trying to we have created an ecosystem for the steel industry in India, wherein we are sourcing products from more than 250 suppliers and selling to more than 2,500 customers. And this number will keep on increasing quarter on quarter.
Can I just request one thing, if possible, if it is not a competitive information, if you can put this number of customers, in whichever form you either business-wise or aggregate.
We do give in presentation, Chirag. We do give
it is there in the presentation.
Yeah, I'll tell you the slide number as well. Slide number 10. Plus, I also gave these numbers in our opening remarks.
Yes, sir. Slide number. I'm on 10. Slide number 10. So.
10.
Okay, we'll take it offline. We can take it offline. No problem. It's fine.
10.
We'll take it offline. It's a good data point for us to track on, at least in terms of addition of active customers. That would be a good data point. Business will automatically flow over a period of time.
Yeah, sorry, Chirag, slide number 7. You can look at it.
Great. Okay, thank you. And all the best.
Yes. Yeah. Thanks, Chirag. Can we have last question, please?
Thank you. The next question is from the line of Rahul Kumar from Vaikarya. Please proceed.
Yeah, hi. Just on this distribution business, other distribution business, how is the profitability and the share of non-steel products moved here from, let's say last quarter to this quarter? And what are the targets here for FY26?
Right. So, see, I mean, here the number of SKUs must be like more than 500. Okay. What we are trading, 90% is steel, and 10% are some products in other construction material, right? And we are slightly experimenting with other commodities, right? But we wish to keep it small. Like I said, our risk management is very, very strong, where we do not want any sharp learning at a cost of our profits, right? So 90% steel, 10% non-steel, and margins vary from 1% to 3% based on the product segment.
Okay.
And yes, I think for full year this should be like 1,000 crore plus business.
Okay. And second question on the inventory, how much mark-to-market hit on inventory we will have to take, let's say, versus the spot prices versus the valuation which we had done at as on June 30th?
No, there is no gain or loss, Rahul.
This is the current spot prices.
That's right.
Okay. And last question, there is another regulation related to the BIS norms for the import of steel related to the inputs. How is that? Is that impacting your business in any way?
So imports have reduced because of that, right? It did impact our volumes, right, in last 2-3 quarters. But we are super confident that internal steel supply in India itself will be so much that we need not rely on imports too much.
Okay. So let's say for this quarter, how much of the steel which you had sold would have come from imports?
0.
Okay. Perfect. That's all. Thank you.
Thanks, Rahul.
Thank you. Ladies and gentlemen, due to time constraints, that was the last question for the day, and I would now like to hand the conference over to the management for closing comments. Over to you, sir.
Thank you, everyone, for joining on to our Q1FY26 earnings call. We shall see you during the next earnings call. Thank you so much.
On behalf of Elara Securities India Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.